This is the Daily Market Comment by Harlan Bospiceros. I'm Maria Pachurdes. Thanks for joining us at XM.com. The US dollar continued to march north on Wednesday, outperforming all the other major currencies, although it pulled back somewhat today. What added extra fuel to the dollar's engines may have been the hotter than expected US retail sales data for January. Both headline and core sales rebounded strongly, exceeding analysts' estimates by a large margin after shrinking for 2 months in a row. More data suggesting that the U.S. economy might avert a recession could keep the dollar supported for a while longer. But calling for a long-lasting recovery remains premature, as ahead of the next Fed meeting, which is scheduled for March 21st to 22nd, the economic agenda is packed with plenty of U.S. data, including the employment and inflation reports for February. Today, the US PPI numbers are coming out, and a decent slowdown could make investors have second thoughts and thereby lock some profits on their existing long positions. The pound was the currency that lost the most ground against the greenback yesterday, feeling the heat of the bigger-than-expected slowdown in the UK CPI data. Both the headline and core rates fell to 10.1% year-over-year and 5.8% year-over-year from 10.5% and 6.3% respectively. And although the former is still in double digits, the slide in the latter may have bolstered expectations that the Bank of England is nearing the exit of this tightening crusade. Although the risks of a sharp recession in the UK have lessened, they are far from vanished, as households are still experiencing a severe cost of living squeeze. Investors are currently assigning around a 65% probability for another 25 basis point hike at the upcoming meeting, with the remaining 35% pointing to no action. The strong rebound in retail sales translated into gains on Wall Street as well, with the tech-heavy Nasdaq rising the most. Despite the rise in Treasury yields on increasing expectations that the Fed may eventually need to take interest rates higher and refrain from cutting them this year, as long as data is pointing to a much better economic shape than previously estimated, investors seem willing to continue adding to their risk exposures. Nonetheless, the bigger picture is far from changed after the retail sales release. The outlook for equity indices remains neutral. Rising yields, a strong dollar, and improving risk appetite appear to be a deadly cocktail for gold. The precious metal extended its steep slide yesterday and may soon head towards the $1,825 support zone. This was today's Daily Market Comment. Thanks for joining us at XM.com.